Meet Bond. Bond isn't a high-stakes gambler or a reckless spender. He's a professional, wearing a sharp blue suit, working a steady job, and following the rules of the American dream. But Bond is currently staring at a check engine light that just turned his morning commute into a financial battlefield. The quote from the mechanic? $500. In the grand scheme of a $28 trillion economy, $500 is a rounding error. It's a dinner for four at a high-end steakhouse or a mid-range smartphone. But for Bond, and for a staggering percentage of the US workforce, this $500 isn't just an expense. It is a systemic trigger. According to the Federal Reserve's latest report on the economic well-being of US households, nearly 40% of American adults would struggle to cover an unexpected $400 to $500 expense using cash or its equivalent. This isn't a poverty statistic. This is a middle-class fragility statistic. We are living in an era where the margin for error has been compressed to almost zero. Why? Because the US economic structure has undergone a massive risk concentration. Decades ago, risks were more distributed. Stronger public transit meant a car repair didn't threaten your employment. More robust employer benefits meant a medical bill didn't threaten your rent. But today, the system is designed so that the individual, people like Bond, acts as the ultimate shock absorber for the entire economy. When the supply chain falters and parts get expensive, Bond pays. When inflation spikes, Bond pays. And when infrastructure fails, forcing Bond to rely on a personal vehicle to even get to his desk, Bond carries 100% of that operational risk. And this is exactly why understanding these hidden gears is no longer optional. It's a survival skill. That's why we started Bond Money Mind. We're here to help you decode the systemic traps that the traditional financial world rarely explains in plain English. If you want to build a more resilient financial edge and see the matrix behind these everyday numbers, make sure to subscribe to Bond Money Mind and join our community. Because in this economy, the best defense is a sharp mind. Now, let's get back to Bond's $500 problem. If Bond doesn't have that cash in a liquid savings account, which statistically is the reality for most people in his zip code, he doesn't just not fix the car. He has to fix it to keep his job. So he reaches for his credit card. At this exact moment, a mechanical friction is activated. He isn't just paying $500 for a new alternator anymore. He is entering a system where that amount is about to be transformed into a high-yield asset for a financial institution and a long-term liability for his household. With average credit card APRs now hovering above 21%, the cost of that repair begins to grow the second he swipes. If Bond's monthly budget is already optimized to the cent, paying for high-premium health insurance, rising rent, and groceries, this $500 creates a liquidity vacuum. To fill it, he might have to delay another payment. Maybe the utility bill, maybe the credit card's minimum. And this is where the system stops being a safety net and starts becoming a trap. We're told that the economy is booming because consumer spending is up. But what if that spending isn't driven by choice, but by survival? What if the strength of the system is actually built on the fact that Bond has no choice but to absorb every shock until he finally breaks? In the next part, we're going to look at the forensic math of how that alternator repair evolves into a $2,000 debt spiral in less than 12 months. We're going to look at the vampire costs that stay hidden until it's too late. To understand how Bond's $500 repair becomes a 5-alarm fire, we have to look past the emotions and look at the forensic math. In the financial world, there is no such thing as a simple loan. There is only the movement of risk and the extraction of friction. Let's look at the balance sheet. Bond swipes his credit card for the $500. On day 1, the transaction is clean. But because Bond is living paycheck to paycheck, a condition that affects 60% of Americans according to Lending Club, he cannot pay the full balance when the statement arrives. He can only afford the minimum payment. Typically, a minimum payment is about 3% of the total balance, or $25, whichever is greater. On a $500 balance, Bond pays $25. But here is the first point of friction: the interest accrual. With an average American credit card APR of 22%, the interest charge on that first month is roughly $9.17. This means out of Bond's $25 payment, nearly 40% of it didn't go toward fixing his car. It went toward the bank's profit margin. His actual debt only decreased by $15.83. Now, let's introduce the secondary shock. Because Bond diverted that $25 to the credit card, his razor-thin monthly budget for groceries or utilities is now short. 2 weeks later, he's hit with a late fee on his utility bill, typically $35. To cover the gap, he carries more balance on his card. The math begins to shift from linear to compounding. If Bond misses just one credit card payment because he prioritized his rent, the system triggers a penalty APR. In the US market, this can skyrocket his interest rate from 22% to nearly 30%. At 30% interest, the math becomes predatory by design. The debt is now growing faster than Bond's ability to amortize it. But there's a deeper layer of invisible math at play here: the opportunity cost of labor. If that $500 car failure caused Bond to miss just 2 days of work while the vehicle was in the shop, and he earns the median US hourly wage of roughly $28, he has lost $448 in pre-tax income. Let's add it up. The repair was $500. The lost wages are $448. The late fees and initial interest are roughly $50. Within 30 days, a $500 inconvenience has created a total economic impact of nearly $1,000 on Bond's household. This is what we call risk extraction. The repair shop got their $500. The employer saved $448 in wages not paid. The bank earned interest and fees. Everyone in the ecosystem remained liquid, except for Bond. He is the only one who absorbed the shock, and he is the only one now carrying a deficit that compounds every 24 hours. In the industry, they don't call this a mistake. They call it revolving debt. It's a feature of the system, not a bug. It's a mechanism designed to ensure that even when the domino stops falling, the cost of picking it back up is higher than the original cost of the fall. This leads us to a critical question. If the math is so clearly stacked against Bond, why is this the primary way the American middle class handles emergencies? In the next part, we're going to look at the systemic villain. It's not a person, and it's not a single bank. It's an incentive structure that rewards fragility and penalizes resilience. We're going to see why "the poor pay more" isn't just a slogan. It's a mathematical certainty in the current US financial landscape. The math is rigged against the unequipped. Grab the strategic mind map below. I've mapped out the predatory web they've engineered to keep you fragile. When we see Bond's debt spiral, it's tempting to look for a single villain, a greedy banker, or a predatory lender. But the truth is more clinical and far more systemic. In the American economy, the villain isn't a person, it's an incentive mismatch. The system isn't broken. It is functioning exactly as it was designed to, by rewarding those who provide liquidity and penalizing those who need it. Let's look at the players. First, the financial institutions. For a major bank, a customer who pays their balance in full every month is actually less profitable than someone like Bond. In the industry, they call people who pay in full deadbeats because they don't generate interest income. The most profitable demographic is the revolver, the person who carries a balance month after month, year after year. Bond's $500 car repair is a golden goose for the credit ecosystem because it's a debt that stays alive. But there's a second, invisible layer to this: the infrastructure trap. In most of the United States, car ownership isn't a luxury. It's a prerequisite for survival. When we underinvest in public transit, we effectively force every worker to become their own logistics manager. This shifts the massive cost of transportation infrastructure and the risk of its failure onto Bond's personal balance sheet. The system rewards this by ensuring a constant flow of demand for auto loans, insurance, and high-interest repairs. It's a complex web, and navigating it requires more than just hard work. It requires a shift in how you see the world of money. This is exactly why we created this channel. We want to give you the tools to see these invisible taxes before they hit your wallet. If you're finding this breakdown of the American credit system valuable, take a second to subscribe to Bond Money Mind. By joining us, you're helping us build a community focused on financial transparency and resilience. We believe that when you understand the incentives, you can stop being the shock absorber and start being the driver. Now, consider the employer's incentive. In a just-in-time labor market, companies benefit from a workforce that is mobile and flexible, but they rarely carry the cost of that mobility. If Bond can't get to work because of a $500 repair, the employer doesn't pay for the repair. They simply find someone else who has a working car. The risk of mechanical failure is a private cost, but the benefit of Bond showing up at his desk is a corporate gain. This is what economists call distributional impact. The benefits of Bond's productivity are distributed upward, while the risks of his daily existence are concentrated downward. And here is the most uncomfortable truth. The US government often finds this fragility useful in the short term. High consumer spending, even if fueled by high-interest debt, keeps the GDP numbers looking healthy. A workforce that is one paycheck away from disaster is often a workforce that is less likely to demand higher wages or better conditions for fear of losing their precarious foothold. So, when we ask why a $500 domino can knock down an entire household, the answer isn't bad luck. The answer is that fragility is profitable. For every dollar Bond loses in late fees and interest, someone else on the other side of the ledger is booking a gain. But how did we get here? In the next part, we'll look at the forensic history of the American dream. We'll trace the timeline from the 1970s to today to see exactly when the safety net was replaced by a tightrope and how the cost of living became the cost of survival. This isn't just a video, it's a survival kit. Download the masterclass slides and keep them as your financial blueprint. Let's stop absorbing shocks and start building. To understand why Bond is standing on such a precarious ledge, we have to travel back to a time when the American middle class had what we call economic inertia. If this were the 1960s or early 70s, a $500 emergency, inflation adjusted, would still be a headache, but it wouldn't be a catastrophe. So what changed? Why did the safety net transform into a tightrope? The answer lies in a phenomenon economists call the Great Decoupling. Starting around 1971, the historical link between productivity and wages was severed. For decades, as American workers produced more, they earned more. But after 1971, productivity continued to climb while real hourly wages effectively flatlined. Bond is working just as hard as his grandfather did, likely even harder given the digital pace of modern life. But he is capturing a significantly smaller slice of the value he creates. While Bond's income was stagnating, the cost of living was undergoing a radical transformation. In the forensic history of the US economy, we see three massive pillars of expense that began to outpace inflation: housing, healthcare, and education. In the 1970s, the average home cost roughly 3 times the median household income. Today, in many American cities, that ratio has ballooned to 7 or 10 times. This means that before Bond even thinks about a car repair, a massive, non-negotiable portion of his paycheck is already locked into a mortgage or rent. The disposable income that used to act as a shock absorber has been redirected into the pockets of the real estate and banking sectors. Then came the financialization of the American household. As wages stayed flat and costs rose, the gap had to be filled. If people couldn't earn enough to maintain their standard of living, they were encouraged to borrow it. The late 1970s saw the deregulation of interest rate caps, most notably with the Supreme Court's Marquette decision in 1978. This allowed banks to export high interest rates across state lines, effectively birthing the modern credit card industry as we know it. Credit wasn't marketed as a tool for big purchases. It became a synthetic wage. Bond isn't using his card because he's greedy. He's using it because the real wage he receives in his bank account is no longer sufficient to cover the real cost of a modern American life. During the 1980s and 90s, another shift occurred: the individualization of risk. We saw the move from defined benefit pensions to 401k. We saw health insurance premiums shift more heavily onto the employee. We saw the rise of gig work and independent contracting. Every one of these shifts moved the burden of uncertainty from the institution to the individual. In the 1960s, a large corporation might have viewed a worker's car trouble as a minor hurdle to be managed. Today, Bond is treated as an isolated economic unit. If his unit malfunctions, the system simply swaps him out. This is why the $500 domino is so heavy. It's not just $500. It's the weight of 50 years of stagnant wages, 50 years of rising housing costs, and 50 years of policy decisions that favored capital over labor. Bond isn't failing. He is living in a system that has slowly removed the padding from the floor and then asked him why he's afraid of falling. As we look at this historical wreckage, the question becomes, how do we survive it? In the final part, we are going to move from the why to the how. We'll discuss the exit strategy, not through empty hustle culture advice, but through understanding how to build a modern fortress against a system designed to keep you fragile. If these numbers feel abstract, check the systemic infographic in the description. I've visualized the scale so you can see exactly where you fit in this machine. Now that we've deconstructed the mechanism, the math, and the history, we arrive at the most important question. How does Bond, and how do you, stop being the shock absorber for a system that thrives on your fragility? The answer isn't a get-rich-quick scheme or a side hustle. It is the intentional construction of a liquidity fortress. The first step in this strategy is recognizing the psychology of the trap. The system wants you to view that $500 car repair as a moral failure or a stroke of bad luck. It wants you to feel isolated. But as we've shown, this is a mathematical certainty for millions. The moment you stop feeling guilty and start feeling strategic, the game changes. In a world of vampire costs, your primary weapon is cash liquidity. We often hear about investing in the stock market or crypto, but for someone in Bond's position, the highest return on investment isn't found in a brokerage account. It's found in a high-yield savings account acting as an emergency fund. Think about it this way. If Bond has $500 in cash, he pays 0% interest to fix his car. If he doesn't, he pays 25%. Saving that $500 effectively gives Bond a 25% guaranteed return by avoiding the debt trap. In the world of finance, a guaranteed 25% return is legendary. That is the bond money mind approach, finding the hidden math that works in your favor. This is why we invite you to be a part of this journey. We aren't just talking about money, we are talking about sovereignty. If you want to continue mastering these strategies and learning how to flip the script on a system designed to extract your wealth, subscribe to Bond Money Mind right now. Help us reach more people who are tired of being the domino and are ready to become the architect. Beyond personal savings, the exit strategy requires aggressive defensive budgeting. This means identifying and cutting the passive extractions, the subscriptions you don't use, the insurance premiums that haven't been shopped around in years, and the convenience fees that bleed your accounts dry. Every $10 saved is $10 of self-insurance against the next $500 domino. Furthermore, we must address the dependency risk. If your entire life depends on a single vehicle in a city with no transit, you are high risk. While you can't build a subway system overnight, you can look for ways to de-risk your life: carpooling, remote work options, or even moving closer to your place of employment. It's about reducing the number of moving parts that can fail and trigger a crisis. Are you a bond mind or just another revolver? Take the 10-question resilience quiz below. Most people fail. Question number 7. Don't be one of them.